Hello and welcome to this lecture on bank failure management, the economics. We will talk a lot during this course about institutional and legal details of the bank resolution framework. But in this lecture, I would like to have a look little bit on the economics. I will start with discussing of why we care so much about banks and the failure of banks, before discussing the trade-off, if not the tension, between different objectives of resolving failing banks or managing the failure of banks. Now, this lecture is going to be an economics lecture, but I will make sure to explain economics terms when they come up during the presentation. So let me start with discussing of what makes banks special. Why are there so many legislative acts, so many regulation about banks? Why do we need a specific bank resolution framework outside the corporate insolvency framework, as we discussed already in a previous lecture? So if you think about the role of banks in modern economies, one important task is to provide payment services, to help people pay for goods and services, to receive their salaries, to pay friends and families. Now, this implies there is a network character of banks, which means that banks are connected with each other through a network such as the payment network, or through other clearing systems, or through the financial markets. A second characteristic, which again is helpful for the economy, is that banks transform short-term liquidity into long-term investment. And here you can put a number on short-term and long-term as you wish. Short-term in this case means sight deposits, so money that you can withdraw at any point in time, but whereas long-term might indicate anything for a day, for a week, for 10 years, for 30 years. So on the liability side, banks hold liabilities that are so-called runnable, that can be redeemed, that can be converted into cash at any point in time, whereas on the asset side, banks hold assets that cannot be turned into cash at short notice, at least not most of these assets. Now, this clearly creates a maturity mismatch. And while this is a concern for regulators and supervisors, at the same time, it also means that banks are fulfilling a critical function for societies, enabling access for depositors to their savings at short notice immediately, while at the same time supporting investment in the real economy. Finally, and linked to the previous 2 points, is that banks have an important function in terms of creating information by screening, by monitoring borrowers, both firms and households. Banks create information that is proprietary to the banks themselves, and that is kept in the bank. That can be hard information in terms of balance sheet information, in terms of payment performance, credit performance, or it can be also soft information based on a relationship between and repeated interactions between the loan officer, branch manager on one side, the borrower, a firm, a household on the other side. Now, all of these functions make banks and the financial services they provide critical for any modern market economy and important for economic growth. So that is the first reason why we really care about the banking system, a sound, competitive, effective banking system. It also means in turn that if banks fail, they have these failures have a very high social cost, because they disrupt the payment networks, they disrupt access to savings and to for firms, households to borrowing, and they might destroy this private information I just mentioned. It also means that competition does not have the same role in the banking system as in other sectors, meaning that just because there's one bank less in the banking system doesn't mean that the other banks actually benefit from it. They might actually be damaged if one of their competitors goes down. Again, for example, through the network character of banks. Now, you could argue that even just this important role of banks justifies why banks are so heavily regulated anywhere, almost anywhere in the world. It's one of the most regulated sectors, maybe with the exceptions of nuclear energy. And again, one reason I already mentioned is this maturity mismatch, which can lead to bank runs. And again, it's a feature, not a bug of banking. This is what banks are for, to undertake maturity transformation, but it makes them also fragile at the same moment. And second, it's the opacity of bank assets. If you think about what is on the asset side of banks' balance sheets, it's primarily loans to firms, loans to households. Now, the information about these assets, again, is private information, primarily. Yes, some loans to some of the larger firms can be assessed from outside because you know if it's a very large listed firm, you can evaluate the performance of this firm. But most of these assets are loans to households, to smaller firms. And again, it's from outside viewpoint, from the viewpoint of a depositor or a creditor, it's very hard to assess the quality of these assets and therefore the solvency position. In the same turn, the solvency position can also change very quickly. What is well-performing loans today, for example, because housing prices are very high, can be poorly performing loans tomorrow because housing prices have dropped over the last couple of months, just to give one example. And even worse, through changes in market prices of certain assets that are marked to market, solvency position can change almost overnight, which again is very hard for creditors, depositors to follow, which in turn gives a limit to market discipline. And again, if you compare a non-financial corporation with a bank, think about a non-financial corporation like a car company. A car company typically has maybe hundreds, maybe thousands of creditors. It has bondholders. It has maybe a bank that has given a loan. It has the suppliers that hold claims. But that's about it. A bank has thousands, 10,000, if not millions of creditors in the form of depositors, which means that these creditors neither have the incentive nor the means to actually properly monitor the performance of a bank and therefore exercise market discipline vis-a-vis the bank. It also, of course, leads to what we like to call in economics the free rider problem. You rely on others to basically monitor and discipline the bank, because for you as a bank depositors with 1,000, 10,000, maybe 50,000 rand in a bank doesn't really, it's not really worthwhile doing this. So for all of these reasons, maturity mismatch being at the core of bank business, the opacity of banks' balance sheets, especially on the asset side, and the limits to market discipline, that's why banks are heavily regulated, and that's why we have what is called a financial safety net, which has lots of different components, regulation, supervision being at the core, also the lender of last resort for short-term liquidity problems, deposit insurance, and to make depositors up to a certain limit whole if a bank fails, again, reflecting that depositors with small claims do not have the incentives or the means to properly monitor banks. And finally, what I'm going to talk about now, bank failure management. What to do when banks fail, how to resolve failing banks. Now, let me come back, before I go into the details, let me come back to the costs of bank failure, which I alluded to already before. And I call these the external costs of bank failure or externalities of bank failure. Why? Because these costs fall on agents, on households that are not involved in decision-taking within banks, within the banking system. So they basically have to bear costs without benefiting from any profit or from being able to take any influence on banks' risk-taking decisions. So the first, and I call these the domino, the hostage, and the fridge problem. Let me go through each of them. The first is a domino problem, which again reflects the network character of banks. One bank gets into trouble, this might affect other banks that have outstanding claims on this bank or that are otherwise somehow connected to this bank. Maybe because they have a similar profile, and if depositors try to withdraw money from one bank, they might then also run to the other bank because it looks very similar. There's also something called common asset exposure. If Bank A that is about to fail has to liquidate some of its assets at a very low price, this depresses the price in the market and might affect Bank B that holds the same assets on its balance sheets and has to market these assets, and therefore gets into trouble simply because Bank A has to liquidate these same assets. So this is the domino problem. With one domino falling, easily other dominoes falling as well. So one bank gets into trouble, this kind of through contagion effect affecting the rest of the banking system. The second problem is what I call the hostage problem. It's hostages that panic because suddenly they lose access to their savings because the bank is not able to pay out their savings anymore, or it is imposes a certain limit on it, or it is there's a delay in getting access to their savings, and all of this leads to panic. And again, it can lead through contagion effects to problems in other banks that otherwise might be completely healthy. But again, the primarily purpose here is to look at the depositors who are kind of victims, hostages in this case, of a failing bank, even though they had no fault at all. Finally is the so-called fridge problem. And here you have to think about milk being left outside the fridge for a long period in very hot weather. And similarly, with this milk turning bad, if you leave it outside the fridge, this soft information, the private information that I alluded to earlier, that is created through lending relationship between banks and borrowers, this soft information is being destroyed if the bank fails, if the bank is being liquidated, because the link between borrower and bank is cut, and there is no more this information kept by a branch manager and by a loan officer is being lost. So the domino, hostage, and fridge problem are costs that come from a bank failure on external parties, on other banks, on depositors, on borrowers that might lead access to their lending relationship. And again, this is one of the reasons why we care so much about bank failures and want to either avoid them or manage them in the best way. And this is also the reason, one of the main objectives of a proper, effective bank resolution mechanism to minimize these costs. But, and I alluded to it earlier, there is a tension, there's a trade-off. Because if you avoid these problems that I just mentioned, for example, by allowing the bank to continue, by bailing out the bank, I'm going to come back to this in a moment, then we have something which is also referred to as the moral hazard problem. Moral hazard is one of the favorite expressions of financial economists. Moral hazard basically means that a party, in this case the bank, is encouraged to take aggressive risks because it knows that it doesn't have to bear the consequences if things go wrong. And it's a different party, it's a third party that ultimately has to pay the losses if the risks go the wrong way. This is what we call moral hazard. So they basically incentives to take risks, aggressive risks, too aggressive risks, because bank management, bank owners know that they don't have to pick up the pieces, they're not losing their shirt if things go wrong. And that is a traditional, intrinsic problem of banks, because shareholders only participate in the upside. Ultimately, if the bank is bankrupt, there's no capital buffer left, then simply governments typically step in and have to pay out depositors, have to maybe pay out other creditors. The worst that can happen to a shareholder is they lose their shares, but they don't have any additional losses. Unlike actually in historically speaking, there used to be a period when bankers had unlimited liability, so they also were actually liable with their personal wealth, or in some cases, so-called double liability. So they not just lost their shares, but also had to pay the same amount again in case a bank went under. Now, this barely exists anywhere in the world, in small cases still, some countries. But again, given that if banks know that they will be bailed out, if they know that the government will step in, then they have the incentives to take aggressive risks. And that might lead exactly to the bank failure that we try to avoid. Exactly to these problems, the domino and hostage fridge problem that we're actually trying to avoid. So this is the tension that I'm referring to between the cost of bank failure that we try to minimize and the moral hazard risks that we are creating by helping banks to forcefully. Now, and by the way, these moral hazard problems become worse as there's less and less equity left in a bank, because then bankers can do what is called the bet for resurrection. I mean, think about yourself. You're always happy to pay the lottery if somebody else pays the lottery ticket and you don't have anything else on your at stake. So this is the basic trade-off that I want to discuss briefly during the rest of my lecture. Minimizing external risks versus enforcing discipline. However, there's also the issue, and we're going to come back to this during the rest of this course and the rest of this learning path, is the ex-ante commitment, for example, to enforce discipline versus what actually happens when things go wrong and the supervisor, the resolution authority really has to step in. So yes, they want to commit ex-ante to enforcing discipline, but what will they actually do in times of distress, especially if several banks are in trouble? So let me try to walk briefly through a couple of graphs to kind of illustrate this as I call it, basic trade-off of bank failure management. So again, you have on the vertical axis, you have this minimizing the external costs. The higher you are on this vertical axis, the more you minimize or prevent the domino, the hostage, the fridge problem. On the horizontal axis, you have enforcing disciplines. The further out you are, the more claim holders are being reimbursed according to the risks they are taking. So equity holder might lose their shirt, junior debt holder as well, senior debt holder might get a haircut, depositors are being protected. So that's the enforcing discipline. This is the minimizing external costs. So in this trade-off between minimizing external costs, enforcing discipline, the ideal position is one where you achieve both. You minimize the disruption to the rest of the banking system, the real economy, while you enforce discipline. Now let's look at the two extreme cases, also two cases that I discussed already in my earlier lecture on the global financial crisis. What you had up here, the bailouts, either in the form of simply providing fresh capital by the government, or looking the other way, what we call regulatory forbearance. Effectively, you minimized the effect, the negative effect on the rest of the banking system, on the real economy. Why? Because banks kept functioning as before. Depositors had access to their savings, lending relationships were maintained, and the payment system, the network character of banking was not negatively effective. So that was also the reason behind these bailouts that we saw during the global financial crisis. Of course, at the same time, this also implied that bankers were effectively rewarded for aggressive risk-taking. What sometimes is described as heads, you win, tail, we, the taxpayer, lose. So profits being privatized, losses being nationalized. Why? Through the moral hazard of creating incentives that allow banks to take aggressive risks, but not taking the responsibility for that. And that was, of course, also the reason why Lehman Brothers was not bailed out. So in this case, you had what you can also call a bail-in, Lehman Brothers being sent into court-supervised liquidation. And that, of course, perfectly enforced discipline. Why? Because now, in this process, over 14 years, every claim holder was repaid according to her ranking on the list. But of course, at the same time, as we also discussed in this lecture on the global financial crisis, this had, of course, very negative repercussions and ultimately triggered the panic in fall 2008 and made the global financial crisis even worse. Why? There was contagion effect through the network. There were subsequent bank failures on both sides of the Atlantic. And of course, lots of lending relationships were lost during this liquidation process. And the negative effects of the Lehman Brothers failure ultimately also informed and motivated policy makers on both sides of the Atlantics to subsequently bail out all large failing banks in 2008 and in 2009. We don't want to have these two extremes. Is there anything in between? So here again, I'm going back to economics and borrow a tool which is called a possibility frontier. Here in this case, I call it the resolution possibility frontier. Are there options in between the bailout and the bail-in that get us somewhat closer to the ideal? But of course, one thing is the possibilities. The other one is what are the preferences of taxpayer and ultimately the ones that take the decisions, in this case, the regulator or the resolution authority. And the idea is to push out this resolution possibilities frontier as close to the ideal that we both minimize external costs and enforce discipline as much as possible. So here I'm listing a couple of these possibilities that are in between bailout and bail-in, between open bank assistance forbearance and liquidation, and that trade off external costs versus discipline to a different extent. And we're going to talk about some of these possibilities during the rest of this course. So let me start with a bridge bank. A bridge bank basically is a measure where a failing bank is being taken over by the government and the claims of the shareholders are being wiped out, but the bank keeps operating as before. So you minimize the external costs, with the exception that, of course, the shareholders will lose their shirt. So you do also enforce discipline to a certain extent. So this is kind of going from open bank assistance to bridge bank, because at least one group of investors, one group of claim holders has seized discipline being enforced against them. On the other hand, if you go from liquidation to partial payout, yes, you send a bank into liquidation, but at the same time, you make sure that all depositors, either up to a certain limit or all depositors, are being immediately paid out through a different bank. So this is something that was originally also envisioned for Silicon Valley Bank, for example, by the Federal Reserve. Only later it was actually then sold to another bank. So partial payouts, there is enforcement of discipline, definitely for non-deposit creditors, for shareholders, but at the same time you minimize the costs for the depositors. You don't address the fridge problem because lending relationships are still being lost, and of course there might also be network problems, domino problems, if some of the claim holders that are being sent into liquidation are other financial institutions. Now, in between, and again, by the way, some of these tools are not necessarily exclusive. So I'm not saying these are different categories and that you have to choose one or the other. You might actually also use combine different tools. But one tool that has been used quite successfully for small banks in the US is the so-called purchase assumption. Now, the legal structure of this procedure varies according to the legal system, but basically what is being done is that the bad non-performing assets are being carved out of a bank's balance sheet. They are transferred together with the claims of the shareholders and possibly some junior debt holders into a so-called bad bank. And then the rest of the bank, the good bank, which could be performing assets, liquid assets on the one hand, deposits on the other hand, is being sold off to a different bank. So it's a split of a bank, and the good part of it, the performing part, is being sold to a healthy bank. That's why it's called purchase and assumption. The healthy bank, the acquirer, purchases performing assets and assumes the liability for depositors and possibly other liabilities on the balance sheet. If there's still a gap here between the liabilities that to be transferred are higher than the assets, there might be also a contribution by the deposit insurance fund, for example, or by the government. So this is a resolution technique. Merger and acquisition is strictly speaking not a resolution technique because it's kind of supposed to be market-based. It's one bank taking over another bank. In this case, in the specific case, a healthy bank taking over a poorly performing bank. But for example, we've had this in the case of Credit Suisse. It was a merger and acquisition officially. It was not a resolution. But of course, there was a heavy hand and support by the Swiss government involved in this merger and acquisition. So effectively, we can also put it here because it was kind of induced by the regulator and it was heavily supported by the regulator. Again, just to make this point again, these tools are not necessarily exclusive. For example, I discussed in the earlier session, the earlier lecture, the case of Banco Espírito Santo. In this case, we had both a bridge bank, Banco Novo, and we had also a split into a good bank and a bad bank. Again, the bad bank being sent into liquidation, the good bank or bridge bank in this case, standalone, continuing to function and therefore minimizing the external costs from the failure of Banco Espírito Santo. So this is kind of the main message I wanted to send you in this lecture. You have this tension between minimizing the external costs from bank failure. Again, the idea not being you want to minimize bank failures, yes, through supervision, regulation, but if it happens, you don't want to prevent it, but you want to manage it in a way that it's least damaging for the rest of the banking system, for the real economy. At the same time, through the use of these different techniques, you do not want to send a message that banks are being rewarded for taking aggressive risks. You want to enforce discipline. And again, by using appropriate resolution mechanisms, you can make sure that those whose action led to the failure also see their claims reduced, if not wiped out, so that you set the right incentives also ex ante. One last point I want to make, and I'm going to come back to this in the next lecture, is I've treated the situation so far as one where one bank fails. I mentioned Silicon Valley Bank, I mentioned Credit Suisse. We know Silicon Valley, of course, was not the first one. There were subsequent bank failures. Credit Suisse was an idiosyncratic failure. However, as I also mentioned in the previous module, it never rains, it almost always pours, meaning a bank rarely fails by itself. You often have several banks in the banking system getting into trouble, failing, and if you have that, if you have something called systemic distress, then you also have a shift in the so-called resolution possibility frontiers. Number one, the preferences of policymakers, including of regulators, move to minimizing the cost for the economy. You care about moral hazard later. You really care about saving your banking system, saving the economy. That's what happened in 2008 in the global financial crisis. At the same time, the possibilities of resolving failing banks reduces dramatically. You cannot merge failing banks with healthy banks. We cannot sell off failing banks with healthy banks if there are not many healthy banks lost. So the toolbox becomes smaller as more and more financial institutions get into trouble, and other tools, other mechanisms, other policy might be needed, which is beyond the realm of this lecture. And let me stop here. Thank you.